contingent claims types. Example is options. And other thing is derivatives. I mentioned that derivative is based on some other product. We call it underlying. That underlying may be financial asset, or we might call instrument, or a financial variable like interest rate, or commodity. It can be weather, many more things. But again, the important thing is derivative can be the underlying can be again a derivative itself, or a combination of a derivative and one or more product of. So this is the basic what we discussed about derivatives. Then we started to discuss about futures. What is a futures transaction? As it says, it's a transaction with a forward commitment. What does it mean? When you enter into a forward transaction or futures transaction, both parties have some obligation to meet on a future date. Futures So this is a definition of future. It's a contract between two parties to buy or sell some underlying asset on a future date. And the important thing is futures is transferable contract. That means you can transfer your commitment to someone else. You can buy as well as you can sell, and you can transfer your ownership and the commitment to someone else. If you have bought a futures contract, you can sell it to another party. Then you don't have any contract. And it's not a private contract. The basic thing is and you cannot customize. Basically, it's a very regulated market and organized by originated through exchanges. They specify the terms of the contract. We call it standardization. If you remember, other than price, everything is fixed by the exchange. Per contract, what is the size? What if it is commodity, what is the quality? Expiration, that means what is the maturity? That's one more thing. Like any other financial contract, derivative contracts also, there's a lifespan, there's a maturity date. And the cash flows of derivatives, most of the time, in many cases, it's at on the expiry date. But there are some instances cash flows may occur or the payoff may occur before the maturity. Then under standardized terms, we have to deliver, how to deliver, everything is defined. Delivery dates are defined. Even though buyers and sellers, they can decide the price, still there's a restriction. That means there's a minimum value by which the price can change. So we call it minimum price fluctuation. But what is the minimum unit in terms of price that can change the price of a futures contract? Then daily price limits, what is the maximum limit that the price can change within a day, and what are the places that you can trade the specific futures contract, and the trading hours, trading days, everything is given according to that standardized terms. So then we discuss few futures contracts. Different underlines for financial futures: exchange rate, it can be exchange rate, interest rate, bond, or stock market index, or it may be agricultural product, energy, or metal. There are many futures contract. If you do a search, you will find it. Then we discuss about one example from each category. The first one, it's about exchange rate. This is dollar yen futures contract traded in Chicago Mercantile Exchange. There are contract size. That means one contract is for 12.5 million yen. This is the minimum price fluctuation. It is at the 5th decimal place. Price is given in terms of dollars. That means what is the price of 1 yen in terms of dollar. That is how you quote the price, not like dollar yen exchange rate, in which we quote the price per dollar. What is the number of yen that we need? But in these futures, it's other way around. Then we discuss this tick value. That is, if the price is fluctuate or change by this minimum price, what would be the change in the value of the contract? So in this example, you just multiply this 12.5 million by this figure, you get the minimum price fluctuation, or the tick value. Sorry, not the minimum price fluctuation, you get the tick value. That means if the price changes by 1 tick, we call this minimum price fluctuation as tick. If the price changes by 1 tick, what is the change in value of the futures contract? And there are delivery months. That means when you can settle this transaction, when you trade a futures contract, you have to specifically select which futures that you are going to trade. That means what is the delivery month. Then based on equity futures, equity index, what are the basic terms of a futures contract? This example is based on FTSE 100. That means London Stock Exchange. Then the interest rate futures. So I'll explain a little bit on this exchange rate futures. Sorry, interest rate futures. Currently, this is based on 3-month LIBOR. So if you go back to the example, it says euro-dollar futures. Remember, though it says euro-dollar futures, it's not euro-dollar exchange rate. It is an interest rate product. Why do we call that euro-dollar? That's dollar deposit taken outside US, basically in London market. That's why we call it euro dollar deposits. Based on that deposit trades, the futures contract is designed. We call it euro dollar futures. It is an interest rate future based on 3-month LIBOR rate. But very soon they are going to drop LIBOR and introduce new benchmark rates. But still they are using LIBOR. So therefore we'll go with this existing product. Even though this reference rate change in future, the concept would remain more or less the same. So before we discuss about interest rate futures, we'll go back to a 3-month deposit. 3-month deposit. Say USD 1 million. If the interest rate is 2%, what is the interest? Interest amount. How do we calculate that? It is the principal value multiplied by the interest rate. Then, since this is for 3 months deposit and the interest rate is quoted annual basis, we have to make an adjustment. We assume 3360 day count. Therefore, 3-month period we have 90 days. Basically, this part is equal to 0.25 or 1/4. So for any interest rate, if we fix the notional amount to 1 million, for interest calculation, this part would be fixed. You see, if the notional principal is 1 million, if we fixed it at 1 million, and for 3 months, this part is fixed. Only variable is this interest. When we can do this, would become 250,000 into interest rate over 100. In this example, it would be 2%. And again, what we can do, even this part, we can simplify. Then it becomes 2,500 into R. Now you need not to put it as a decimal. You can just put it as 2. So if you go back to the example, you can see this 2,500 is appeared in the standardized term. That's how this 2,500 comes in that standardization, because the product, interest rate future product, assumes a notional amount of $1 million and a deposit of for a 3-month period. That's how this 2,500 comes into the picture. The other thing, so
excuse me, sir, like this 250,000, can you like explain that if you won't mind? Like, I could get this 250,000. How we arrive, sir?
1,000 into sorry, 1 million into 90 over 360. It's for the 3 months deposit. Day count is 90 over 360. That is 1/4, 0.25.
Yes.
0.25 into 1 million, you get 250,000. Then divide by 100, you get 2,500.
Yes.
Okay?
Correct. Okay. Thank you.
Then, in this calculation, what we did, we assume on this amount, we get interest. Then at the maturity, we get more than 1 million. But on the futures, instead of it's a interest bearing product, it is considered like a discounted product. So 3-month period, you get 1 million. Interest rate is, or the discount rate is 2.5. Then how much you have to deposit here? It's only 975,000. This interest rate futures product worked on this basis. It is considered as a discounted product. So then make it easy to do calculation and things. That's why then we think on the maturity we get 100. If the interest rate is R, here you have to place only 100 minus R. If this is 2%, we drop that percentage, we just get the numerical figure. Here we get 100 minus 2, 98. We call this is the price of the futures. This is the price of the futures contract. This varies when interest rate changes. If it goes to 2.2, what would happen? This will go to 97.8. If this reduces to 1.8, this will go to 98.2. Here, the price of the futures product is basically 100 minus the interest rate. What is this interest rate? 3-month by 100 minus interest rate is the price. Then we don't want to calculate too many things. Just take this price and calculate the changes in interest rate. Multiplied by that, you get the profit or loss. We'll discuss that later. So this is how we get the price of the futures. Now tell me what would happen futures price to the futures price if interest rate increases. What would happen to the futures price if interest rate increases?
Future price will decrease.
Futures price will decrease. Why? This is 100 minus interest rate. That is the equation. When this part increases, 100 minus a larger value, then answer goes down. So when the interest rate increases, futures price decreases. Clear? Or vice versa. If interest rate decreases, futures price increases. Now you are clear about how to get this futures price and the relationship between interest rate and the futures price. Now tell me what would happen if you buy a future. If you buy a futures contract, what do you agree? So this is based on 3 months. It's a futures contract. So assume this is today, T equals 0. Today you buy a futures contract, say December futures contract. That means December 2020. What does it mean? To make it simple or the more clearer, we'll put a price as well, 98. What does it mean? When you buy a futures contract, you agree to lend $1 million. When are you agreeing to lend $1 million today or someday in the future? That is a future date. That's why we call this is a futures contract. December. Starting from December to 3 months. End of February. Sorry, March. Somewhere in the March. That depends. If you place it December 15th, it could be March 15th. Likewise. However, this is the basic concept. You don't lend anything today, but you agree to lend $1 million on a future date, but for a 3 months period. This period is fixed, 3 months. Why do you enter into such agreement today? Why do you enter into such agreement today without waiting till December and make the loan? You think interest rate will go down in the future, but you want to enter into agreement to lend in December for a 3 month period based on the current interest rate structure and the expectation. So therefore, when you say buy a futures contract, basically that you agree to lend $1 million for a 3 month period beginning in future, not today. That future date is decided based on the which contract that you bought. But remember, buy a futures means lend. Buy means lend. Okay, what would happen now? What is the interest rate that you agree to lend in December? That is 2%. Why? Price is 98. How did we derive that 98? 100 minus interest. So this is 98. Therefore, interest rate is, so we agreed to lend $1 million for a 3-month period starting from December 2020 at 2%. Clear? That's the agreement. Now what would happen? Interest rate goes up to 2.1%. Now you have an agreement to lend $1 million at 2%. After that, when you are getting closer to December, somewhere here, say November 15, now 3-month interest rate starting from December to March is 2.1%. Are you making money or losing? If you haven't entered into this transaction, you could have lent your money at 2.1%, but you have already agreed to lend it at 2%. So in this situation, you lose. How does it reflect in the futures price? Now futures price will go down from 98 to 97.9. Correct? Now the futures price goes down because interest rate has gone up. In the futures price, you can see you bought it at 98. Now the market price is 97.9. So you are losing. But as you expect, if interest rate goes down 2% to 1.9%, what would happen? Instead of 97.9, futures price will increase to 98.1. Correct? You bought it at 98. Now the price is 98.1. You make a profit. Clear?
In Sri Lankan market, whether futures are traded like? No,
unfortunately, in Sri Lanka, there's no futures market for any product, for any underlying. Because we don't have a futures exchange.
In what instance we can use futures, like countries the users who futures?
Sorry?
What is the importance of using futures?
What is the importance of using futures? As I mentioned, this interest rate futures, I'll explain using this interest rate futures. You are here today. You think you have a cash flow in December. $1 million. You don't want this $1 million for the next 3 months from December to March. What do? When you receive the cash flow here, what do? If you don't want, you make an investment. Say you need it in March. So for this period, what do? You make a deposit or make some investment. But you are here today. What do you think about future interest rates? You think in the future interest rate will go down. But you want to invest this at a higher rate. So what do? Use a futures contract to lock the interest rate for this 3 months period. Say, assume today dollar 3 months LIBOR is 1%. You may not get 1% for this. You might get something like 0.75 because already market is expecting interest rate to go down in future. So somewhat will be priced in the futures price as well. The expectation will be priced into the futures price that will be there. But you may think real or the actual interest rate would be much lower than that. So that's why that is from a lender's perspective. Lenders, they think interest rate will go down in future. So they want to lend it or lock the rate today. On the other hand, borrowers, if they think interest rate is going to go up in future, they can enter into other side, seller futures. Lenders, they will buy a interest rate future. Borrowers, they will sell a futures contract. Not only that, you can hedge your existing position also for a specific period. Assume you are a lender. You already granted a loan, $1 million, at a fixed rate, 2%. You already granted a loan at a fixed rate, 2%. The lifespan of this is much longer. But you think interest rate will go up for this period. What you can do? You can sell a futures contract. Then what would happen? Say you sell it at 98. Then the interest rate goes up. It may be 97.5. You can buy it at a lower rate. You make this 0.5 difference as a profit. So your loan is only 2%. Now you get this 0.5% additional. Even without having this loan, this underlying, still you can carry out this transaction. This is speculative because you think in the future interest rate will increase. If your view realize, your expectation realize, then you make a profit. If it goes other way around, then you will make a loss. So any futures contract, not only interest rate, any other, you can use for speculative purpose as well. Based on the market view or your view on the market, you can enter into a buy transaction or a sell transaction. Now, in this tick size is 0.0025 in the euro-dollar futures contract. If you go back to the example, the standardized terms are given. The tick size is 0.0025. That means if the futures price can be changed only by this amount. That means interest rate can be changed only at the third and fourth decimal place, but by 25. So if the price is now 99, what would be the next lowest figure, or what would be the next? What would be the high figure? What would be the next low? This could be 99.0025. This could be 98.09975. These are the three possible prices. You cannot have any futures price in between these two or these two, because this is the minimum price fluctuation. You are not allowed to change it by 0.003 or 0.0035, 0.001, 0.0001. You are not allowed to change like this or something like this. It should be minimum 0.0025. What is the tick value? If the price changes by this amount, what is the change in that your income or the loss, profit or the loss? That is the change in value of your interest income. If you have to use the previous way, because you have lent 1 million at whatever rate, if it's changed by 2,500, then 1,400. You have to do all these calculations to find the value. But instead here, based on the standardization, it is very simple that 2,500 into 0.0025, you get $6.25 as the tick value. That means if the price changes by the minimum allowed price level, then the profit or loss would be $6.25. Then you don't have to do any calculation, you know that. Okay. If the price changes from 99 to 99.0025, assume you are a buyer. Is it a profit or a loss? You bought it 99. Now the price is 99.0025. Price has gone now. So as a buyer, you make a profit. What is the profit? How many ticks here? The change from 99 to 99.0025, just one tick. What is the value of one tick? 6.25. Your profit is 6.25. If the price goes up to 99.5, what is the profit? How many ticks? How many ticks are there? $200 ticks. Is it correct? Then what is the profit? For a one tick, you get 6.25 or 200, just multiplied by 200. You don't want to worry about 1 million and interest rates, nothing. Only the price change in terms of ticks. That's how interest rate futures, not only interest rate futures, even other futures works. But specifically, this is how interest rate futures works. I just wanted to explain you how this 2500 came and this 6.25 peak value came, and what is the meaning of futures price. How do we get the futures price? Interest rate, futures price, $100 minus interest rate. Again, this is just the numerical value. You don't put it as a decimal. 2%, you just use as 2, not 0.02. You just use as 2. Then 100 minus 2, you get 98. No need to work with decimal figures or percentages. That's how interest rate futures work. For any futures contract, profit or loss would be number of ticks into tick value into number of contracts. Profit or loss would be number of ticks, movement, tick value, and the number of contracts. In my previous example, futures price moved to 99.5. How many ticks? 200 ticks and positive, because now the price is higher than the earlier price. Move is positive, so you get a positive figure. Otherwise, if it is 98.5, it should be negative and you get a loss. Here it's a positive. Tick value is $6.25. In the previous example, I just assume we bought only one contract. But if you want, instead of 1 million, say you want to lend 5 million, then what do? You have to buy 5 contracts. If you want the notional amount to be 5 million, then you have to buy 5 contracts. If you have bought 5 contracts and the price moved from 99 to 99.5, then what is the profit? That number of contracts comes into play here. We multiplied by the number of contracts. There are 2 terms of this equation. This is the profit or loss per contract. Number of ticks into tick value, number of ticks into tick value, that is the profit or loss per contract. Then if you have bought or sold more than one contract, what do you have to do? Multiply the profit or loss figure by the number of contracts that you have. So this is common for any futures contract, whether it's interest rate, commodity, foreign exchange, whatever it is. Any question?
When it comes to futures, like is it like FRA, like forward contract?
If FRA is also FRA is not like futures,
Okay.
but almost same effect would be there, but calculation and things are different. FRA and futures. Yes, FRA for forward rate agreement also, you enter into a lending or a borrowing in the future for a specific period. Yes, in that sense it is true, but the way it works is different from the FRA. You will see.
That means once we get into a future contract, you have to go with it. Like you don't have options kind of thing. Once you get into a contract, either you have to buy or sell.
No, you enter into a contract means either you buy or either you sell. Either you buy or sell. If you enter into a buy transaction, that means you agree to lend, but you don't have to lend anything. At the end, what would happen? You calculate the closing price and your agreed price. The difference profit is calculated and paid to you, or you pay to them. If you are in a losing position, you pay that loss to the exchange, or the exchange will pay to you if you are in a profit position. That's what would happen in a futures contract. And the other thing is, as I mentioned, if in the futures contract, so once you enter into a futures, say today you enter into a December future interest rate, by October you think now the market has moved, it will come back and I want to get out. What you can do, you can sell the futures contract. You bought the futures contract, now you can sell it, because that can be traded in the secondary market. But in a FRA, you can't do that. It's over the counter contract. In a FRA, you have the forward commitment. In a futures, yes, you have the forward commitment if you hold it until maturity. But before that, what you can do, you can get out. You can do the opposite transaction. What we discussed, the concept close out. You can do a close out. If you have bought a futures contract, you can sell the same futures contract. If you have sold the futures contract, to close it out, what you can do, you can buy the futures contract. So then you are out of the market. Once you close out, you are out of the market. But in a FRA, say you buy a FRA with one counterparty, then later before maturity you sell the same FRA with another counterparty, but still you are running with two transactions. It's not, you don't go away from the market. Whatever the market movements, yes, it won't affect you, but you take the counterparty risk of two parties in a FRA, because it's a over the counter market. We'll discuss FRA maybe next week or week after that. In a futures contract, any futures contract, yes, you have the liability or the obligation to meet that, but before that you can close out and walk away. That possibility is there.
Even central bank don't enter into future contract. Like
sorry?
Even central bank doesn't enter into future contract.
For reserve management activities, we did back in 2014, but later again we stopped that. Not in the local market, in the international market. So this is the equation I explained. Profit is the number of ticks moved into tick value into number of contracts. This is true for any futures contract, but what would change is what is a tick from one futures contract to another futures contract. Tick may change. The definition of a tick may change, and the tick value may change. So we'll go through a few examples. These are easy. Okay, this is profit futures. This is on the yen futures contract, what we discussed earlier. Importer buys 20 CME June. What is the meaning of this 20? This 20 means the importer has bought 20 contracts. What is the size of one contract? If you go back to this, this is the size of a one contract. 12.5 million yen. One contract is 12.5 million yen. Now, that importer wants to buy 20 times of this. $250 million yen. Can you hear me?
Yes.
Yes, no? There was a pop-up saying you lost some connection. Problem. Okay. So 20 contracts, that means he wants to buy 250 million yen because one contract is for 12.5 million yen. So number of contract is 20. Then we don't have to worry about the that 250 million. So you don't want to use with big numbers. This is the price at 0.008784. You can see there's only 6 decimal points. What is this price? How do we interpret this price? This is the price that he agrees to pay to buy 1 yen. This is the price in dollars. To buy 1 yen, he agreed to pay $0.008784. Clear? Because that is the specification of this dollar yen futures contract at CME. The buyer has agreed to pay $0.008784 per yen, and he has bought 20 contracts. He has bought June futures. Assume now we are okay. We can assume this the next year June. He has bought this contract to be settled in June 2021. So 1 month ahead of its maturity, that means somewhere in May, the futures position is closed out at 0.008715. What does it mean by position is closed out? Since he has bought 20 contracts, to close out, we has what he has to do? If he has bought, to close out, he has to sell it. So he has sold 20 contracts at this price. That means he get $0.008715 per yen. Is he making money or losing money? This is the price that he bought. This is the price that he is selling.
Losing.
He is losing. Why? The selling price is lower than the purchased price. He is losing money. What is the loss? What do you have to do? Calculate the difference. And multiply it by 2. Why? If you go back, you can see the minimum tick size. So the price fluctuation is 5, but at the 7th decimal place, not the 6th. 1, 2, 3, 4, 5, 6, 7th decimal place. But here, prices are quoted in the 6th decimal place. So to calculate the number of ticks, it is just the difference multiplied by 2. In decimals, you get 0.00138 after multiplying by 2. That means the market has moved 138 ticks, but against the importer, because he bought the futures contract, price goes down. Then per contract, the loss is number of ticks into tick value. Then per contract, he is losing $862.5. Since he has bought 20 contracts, the total loss is 862.5 into 20, 17,250. So if you can get the same answer, what you have to do, this is the price that he bought yen against dollar. But for how many yen? 250 million. So you can multiply this figure by 250 million and calculate his cost. Then this is his selling price. Again, you can multiply this figure by 250 million, get the figure. The difference, you should get 17,250. But since this is standardized, you don't have to worry about whether it's 250 million or whatever. That depends on the number of contracts. We simplified it into number of contracts. And for a one tick, what is the value? We know it. So you don't have to do all those things. What you have to do, calculate the number of ticks based on the difference. Is it clear? Because this is given in the contract specification. Tick value, this should, not this euro dollar. Tick value, this is 6.25. How do you get this tick value? 12.5 million yen into this. Then you get 6.25. If the price changes by 0.0006 and 5, value of this yen in terms of dollar will be changed by $6.25. That's the meaning of tick value. Per contract, 12.5 million yen is included. If the price changes in the 7th decimal place in terms of dollar, what would be the change in value of this 12.5 million yen in terms of dollar? It is $6.25. So we just use that figure to calculate the profit or loss. So we'll move to the next example. It is based on
that example. When we calculate the loss in tick, why we multiply by 2?
This is because that this is the change in price. If you don't multiply by, if you go back, the minimum tick size is 0.00. There are 6 decimal place or 6 zeros, and then only you get 5. That means this is in the 7th decimal place.
Okay.
But here there's only 6 decimal places. So 2 ticks, you have to move the price by 2 ticks to change the one position in the 6th decimal place. Say 0.008784 to 0.008785. How many ticks?
1, 2, 3, 4, 5.
The price is given only up to 6 decimal places. What would be the next price upside? Oh, yes, 845. Because the minimum price change is at the 7th decimal place, but the value should be 5. You cannot have 1, 2, 3, 4, 6, 7, 8, 9. You can't have only 5. Then this is 1 tick. The next price would be 8785. This is another tick. Then from here to here, it's 2 ticks. 4 to 5, there are 2 ticks. So in our example, it's from 8784 to 8715. How many ticks? Just the difference times 2. Clear?
That means
Because the tick size is at the 7th decimal place, but the price is only up to, in this example, it's only up to 6 decimal places. Is it clear?
yes.
So that's why for any futures contract, you should know what is the tick size. Then based on that only you have to calculate the number of ticks. Okay, we'll move to the next example. It's on the index, equity index. In that investor sells 5. This is the number of contracts. 5 contracts on FTSE 100 futures at 5378. This is the index figure. And he has held it until expiry. On that last trading date, the official closing price is 5005. So he sold it at 5378 and the position is closed or the contract expired at 5005. Is he making money or losing money? The first thing. He sold at a higher rate. Then effectively, now price has gone down. You can think that he has bought it at 5005. He sold it at 5378. Is he making money or losing money?
Making money.
Sorry? He sold at a higher rate and bought at a lower rate. Making money or losing money? Huh?
Making.
He's making money. So these simple things should be clear. You sold at a higher price, bought at a lower price. So you make a profit. Now go back to these. These are the definition. Value of the contract is 10 sterling pound per index point. Quotation is also in index points, that 5005 is the index points. So for each point, the value is 10 pounds, but the tick size is half a index point. So the one unit is valued at 10 pounds. Then what's the value of a half a index point? If the index point is valued at 10, 5. Half index point value is 5. So the tick value is 5. Clear? Now, how many ticks the market has the market moved from 5378 to 5005? How many index points? It is just the difference between 5378 and 5005, 373. So the market has moved down by 373 index points. Clear? This is the index point or the index value when he sold it. This is the index value when the position is expired. The market has moved downward by 373 index points. How many ticks? One index point is equal to 2 ticks, because one tick is half a index point. Clear? One tick is half a index point. Now one tick is half a index point. So one index point is equal to 2 ticks. So therefore, to calculate the number of ticks, you have to multiply it by 2. Then you get 746. That is per contract. So the profit per contract is 746 into 5. That is 3,730. But he sold 5 contracts. Then multiplied by 5, you get this figure. But this index futures, you need not to calculate the ticks unless it's given in the number of ticks. What you can do, 373 is the number of index points that the price or the market move. You know the value of a index point. What is the value of an index point? 10 pound. So just multiply this by 10. You get this same figure. That is same here. Once you multiply it by this 373 by 2 and multiplied by 5, it is same as 373 multiplied by 2 multiplied by 5. 2 multiplied by 5 is 10. That is the value of a index point. So therefore, you can calculate from this straight away to the profit per contract just by multiplying the number of index point by 10. Then you multiply that by 5. This is the number of, what is this 5? This is number of contracts. Clear?
Yes.
In futures, you don't want to worry about what is the underlying things like that when you come to calculate profit or loss. But you have to understand what is the tick size, what is the tick value, and how many contracts. So another example, again, it's based on FTSE 100. 6. What is this 6? That's the number of contracts that he bought. That investor has bought 6 contracts at 50, 50, 50. And on the expiry date, the index is 5156. Is it a gain or a loss? Is it a gain or a loss? He bought it at 5050. At the expiry, index is at 5156. Right? Index has gone up. Is it a profit or a loss?
Profit.
It's a profit. You can consider this as the price. It has gone up. And you are a buyer. So it's a profit. How many ticks? Sorry, how many index points? Market has moved up by 106 index points. The difference between these two figures. 106 ticks. Sorry, 106 index points. How many ticks? 212, because one index point equals to 2 ticks. So therefore 212. What is the tick value? 5. Then what is the profit per contract? 212 into 5. 1060. And what is the total profit? 1060 into 6, because yes, so about 6 contracts. So first we have to find whether the position has moved in favor or against the investor. So that depends on whether he is a buyer or a seller. If he is a buyer, the index should have moved upward to make a profit. If the index moved downward, then buyer makes a loss. But it is other way around if the investor is a seller. So the profit, index moved by 106 points, it's a profit. Then the number of ticks is 106 into 12, 106 into 2, that is 212. Tick size is 5. So multiply this 212 by 5, you get 1060. He has bought 6 contracts, so therefore the total profit is 1060 into 6. Again, as I mentioned earlier, you can multiply this 106 by 10. Then you get this 1060 profit per contract, and multiplied by that, by the number of contract 6, you get 6360. Clear? How to use this equation?
Here the
For any
important
futures contract, you can use this equation. Only thing is, you should be clear about what is a tick and how many ticks has the market moved and the tick value. Yes.
when it comes to calculate the profit in ticks, in the sense number of index points into two in the sense
for this specific futures, FTSE futures, it is easiest way to calculate the number of index points, the difference multiplied by 10.
Yes. Okay.
Because the one index value is 10 pounds.
10.
So you can do calculate the number of ticks. That means number of index points into 2 is the number of ticks. Value of a tick is £5. You can do it either way, but the easiest way, I think, calculate the index points multiplied by 10. Then you get the profit or loss per contract, then multiplied by the number of contracts. But make sure all these figures are given in terms of index points. If it is given in terms of ticks, then you have to multiply it by 5, not by 10, because the value of a tick is 5. That you have to make sure the difference between index point and a tick. Clear?
Yes. Yes. That means when it's given by price, we have to use the price.
Yes. You have to make sure about all these terms for different contracts, different specification. What does it mean by a contract size? What does it mean by minimum fluctuation or the tick size? And what is the exact tick size? And what is tick value? Contract size, tick size, and tick value. You have to be clear on these. So here, what is tick value, or the tick size, is completely different from the tick size here. It's a half a index point is a tick. Here, price in terms of dollars at the 7th decimal place, but it is 5.000005, not 1, 2, 3, something like that. 5. Then the price has to change by this amount at minimum.
Okay.
Not less than that.
Either increase or either decrease.
Either decrease by this amount, not by the
okay.
fraction of any other fractions. That's why in this example, the next price would be 0.0087845 or 835. Either goes up by 7th decimal place by 5 units, or goes down by 5 units at the 7th decimal place. 835 or 845 at the end. You can't have 844 or 846. It won't happen. That move we call a tick. Then from here to here, how many ticks? You have to be clear on that. In this oil futures, you can see just 1 cent is the tick size. You cannot have the 3rd decimal place in futures prices because the tick size is 1 cent. And the price is or the contract size is 1,000 barrels, not just a 1 barrel. One contract is 4,000 barrels. Price is given in US dollars. The price can fluctuate only by a 1 cent. Okay, if the price change by 1 cent, what is the value change in the value of the whole contract? 1,000 into 0.01. That means $10. The tick value would be $10 here. If the price change by 0.01, the value of the contract changes by $10 because per contract 1,000 barrels. So when it comes to calculation, you don't want to worry about how many barrels or things like that. Say, consider this example. So it's just one contract. If you bought 10 contracts, you need not to worry about that is about 10,000 oil barrels. You don't have to worry about. What you have to worry about just 10 contracts. That's it. And the next price would be 97.73 or 97.71 because the minimum price change is at the second decimal place and by 1 unit, 1 cent. That you have to be clear for different futures contracts, different tick values, tick size. You have to be clear on that. So in general, long futures, what does it mean by a long future? In any product, we call it you are long when you have bought the product. So you are long futures. That means you have bought the contract. Then how do you calculate the profit? On the expiry date, it is just the difference between S is the spot price on the expiry date and the F is the futures price that you agreed. The difference is profit. If the spot price is lower than the futures price, that means you are making a loss. If this is negative, that is a loss. So just the difference between spot price and the futures price. If it is straight away in terms of price. If it is value, then you have to calculate the value like a index futures. What is the spot index value and what is the index value that you agreed? That will give you the profit or loss in terms of the index points. Then you have to multiply it by 10 to get the profit in terms of monetary terms. So this is an example. If you have bought oil futures at 97.72 and hold until maturity. Okay. On the maturity date, what would be your profit or loss? That depends on the spot price on that date. That your profit or loss depends on the spot price on the expiry date. So the relationship between the spot price of the underlying at expiry, and the profit on the y-axis, the relationship, we call it the payoff diagram. This diagram we called payoff diagram. I'll explain you how to get that. You bought the oil futures at 97.71. You bought the futures contract at 97.71. On the expiry date, if the spot price is 97.71, what is your profit? Per barrel. You bought it at 97.71. On the expiry date also, profit is 97.71. What is the profit? It is 0. The price is same as the price that you agreed to pay. What would be the profit spot 97.71, profit equals 0. What would be the profit if the spot price is 0? You agree to buy it at 97.71. On the expiry date, there's no value for oil. Are you making a profit or a loss?
Loss.
You are making a loss because you bought it at, agreed to buy at 97.71, but there's no value. Value is 0. So the profit is minus 97.71. When the spot price is 97.71, profit is, it's a loss by the same amount. Now assume the spot price is 100. Are you making a profit or loss? You bought at 97.71. Now the price is 100. Price is higher than the
Profit.
the price that you agreed to buy. So it's a profit of 2.29.
2.29.
Correct? So you can put whatever it is, 150, what is profit? 52.29. You can make it 70, then it's a loss of 27.71. If you plot this in a graph, that graph contains axis as usual. Y-axis shows the profit, and this is spot price. When the spot is 97.71, profit is 0. This is 0. Plus side, negative side. When the profit is, when the price is 97.71, your profit is 0. When the price is 0, your profit is 97.71. Price is 0, your profit is somewhere here. At 100, somewhere here. You get this 2.29. So if you plot all these, you will see everything will fall on a line, because the relationship is 1-to-1. If the price increase by 1 unit, $1, profit will also increase by $1. If price decrease by $1, profit will decrease by $1. You can try it. Okay. When price is 97.71, 0. When the price is 96.71, 98.71, just calculate profit. This is -1, this is +1. If you make it 99.71, this is 2. If you make it 95.71, this is -2. Just a $1 change. It will be reflected in the profit dollar. So there's a 1-to-1 relationship, a linear relationship. So therefore, you will see a straight line like this. The slope is 1. For 1 unit change in the price, profit also changes by 1 unit, increase or decrease. If price increase, profit increase. If price decrease, profit decrease. So this is the payoff diagram for a futures contract. For any futures contract, this would be same, but the slope may change depending on the futures contract. For example, for an index future, index value is 10 rupees. So therefore, index point changed by 1 unit, profit changed by 10 pounds, not by 1 pound. So therefore, this it may be a very much steeper line, but it's still a straight line. This is for futures. This is easy and very straightforward. It's a straight line, but remember the concept: profit against the price. That is the payoff diagram. That's how we derive this concept. We use in the future. We will use in the future in options as well, but it's bit complicated than this. But if you understand what is this, it is not that difficult. Is it clear how to draw the futures payoff diagram for a futures contract? That is based on this. So you can see what is the maximum profit. There's no limit. Price increases, the profit increases. Further you move away, price increases. So therefore, theoretically, there's no limit for the profit. So therefore, when you buy, if you are a buyer of a futures contract, that means you have a long futures contract, maximum profit is unlimited. If the price moves above your purchase price, then you make money. Whatever the move, you make money. But what is the maximum loss? If the price goes to 0, what is the figure here? It is same as this 97.72. You agreed to buy at 97.72, that now there's no value. What does it mean? You lose everything, 97.72. So the figure here is minus 97.72. So the maximum loss is it is limited to the pre-agreed futures price. So in that sense, payoff is not symmetrical. Your profit opportunity is, if you have a long futures contract, your profit opportunity is much higher than your losses. But when it comes to short futures, that means you have sold a futures contract, then the profit is other way around. The futures agreed price minus the spot rate. Then the payoff would be like this. Why? You agreed to sell it at 97.72. Now the price is 0. So you get the whole thing as the profit. So this should be 97.72. So the maximum profit that you get is limited now to the pre-agreed futures price. That is the maximum profit that you can get. When you can get it, that's the time when the price of the underlying asset goes to zero. Very rarely that would happen, but theoretically, yes, that can happen. So the same difference distance here would be your maximum profit. It should be the same thing. But the risk here is you have sold, but price can increase without any end. So then you may incur a loss without any limit. Therefore, maximum loss is unlimited in that instance. So selling a futures contract is riskier than buying a futures contract. Why? If you buy a futures contract, maximum loss is limited. But if you sell a futures contract, maximum loss is unlimited. So selling a future or having a short futures position is riskier than having a long futures contract. So to draw this payoff diagram, you can still follow the same concept. At different price, calculate the profit. But only thing is, when you calculate the profit, now it's other way around. Agreed futures price, that is your selling price, and what is the spot price, that is your buying price. The concept, selling price minus buying price, selling price minus buying price remains the same. Even here, same concept. This is sell. You have a long futures, that means you have bought, and on the expiry date you sell it at the spot price. So this is the selling price. This is buying price. That concept remains same, but depending on whether you have a long position or a short position, what is your buying price is what is your selling price may vary. If you have a long futures, your buying price is that futures price, the agreed price, and the selling price is the on the expiry date, what is the spot price. Same concept can be used even before the expiry, but we are not going to discuss that because there's a small difference in time value, because this forward price is agreed to pay on the mature expiry date. But if you close out position, you will do it before the expiry date. Therefore, there may be very small differences in time value. So therefore, we are not going to discuss that. And even the payoff diagrams are only for the profit or losses on the expiry date. And remember this key: when you have a long future, what is the maximum profit and what is the maximum loss? When you have a short future, what is the maximum profit and maximum loss? Out of these two, what is the riskiest transaction? So basically, when you are long, like any other asset, when you are long, that means you buy a futures contract. If the price of the asset increases, you make a profit. If you are short, that means you have sold a futures contract. If the price of the asset falls, then you make a profit. This is very obvious thing. You bought, price increase, profit. You sold, price decrease, profit. But in this instance, you bought, price decrease, then you make a loss. You sold, then price increase, you make a loss. Very common concept. There's no difference for that in the futures as well. The same thing. So the outcome for the buyer or the seller, whether you are making a profit or loss, that depends on the price of the underlying on the expiry date, not only on the expiry date, even before that. How the price of the underlying asset moves, that will have an impact on the value of the futures contract. So that is the market risk of the futures contracts. Value of the futures contract will vary when the price of the underlying asset changes. That is the market risk. On the other side, the counterparty risk, because you enter into a transaction with another party. The counterparty risk is that the other party does not honor the obligation. But in futures contract, it is very low because these transactions are settled through the exchange, and we split the transaction between two parties into two contracts as two transactions between the parties and the exchange. Buyer will have a buy transaction with the exchange, seller will have the sell transaction with the exchange. So therefore, basically counterparties to a contract futures transaction ultimately face the risk of the exchange. With the other party honor the transaction or not, that does not impact on the other side. There's no impact to the buyer if the seller default. There's no impact to the seller if the buyer defaults. Exchange will honor the transaction, but not everybody can do the transaction through the exchange. You need to have brokers. So therefore, broker has the obligation to fulfill the transaction requirement with the exchange. Client has to fulfill that with the broker. So therefore, there's exist small risk between broker and the client. Either the broker may default or the client may default, and the broker and the clearinghouse. Broker may default to the clearinghouse or clearinghouse may default to the broker. That the last incident, it's very rarely or a very rare occurrence. It won't happen. Almost zero. So therefore, we assume futures, not only futures, whatever the transaction going through exchanges have no counterparty risk. It's zero default risk, though there's very small risk. And the other thing is liquidity risk. Liquidity means whether you can buy or sell the futures contract without having any adverse impact on the price. Most of the futures contracts are very liquid because specifically the contract is standardized and traded through the exchange. Therefore, the liquidity is high. There are many parties who is willing to quote a price, and there are many parties who is willing to trade. Therefore, the futures markets are comparatively liquid to forward markets. Futures and forwards, as I mentioned, it is an agreement to buy or sell something on a future date. The difference is futures contracts are standardized and regulated and settled through the exchange. Therefore, one contract is a single product, but in a forward market, it may not be the case. different parties may enter into different forward contracts on the same underlying, but maybe different values or different tenors. So therefore, it's not easy to trade that, because forward contracts are basically customized to suit one or the other party. But futures is not like that. Futures are standardized products. So it's like a pen. You can sell the pen. It's not customized to someone else's requirement. It's a generic product. So therefore, futures are tradable, whereas forwards are not. Due to that reason, futures contracts are much liquid. So forwards, as I mentioned, very similar to futures market, and we discussed the difference between exchange traded products and OTC products at the very beginning of the course. So I don't think we have to go through this, because forwards are over-the-counter markets. Contracts are customized, as I mentioned earlier. So therefore, no secondary market, but in futures, there's a secondary market. Therefore, it's liquid. But both are forward commitments. Both parties have the obligation to honor the transaction in forwards and futures. But forward, just an agreement between two parties. That's why we call OTC market. If the other party defaults, you make a loss. That is not there in the futures market. For futures, they do mark to market every day, but in forwards, it may not take place because it's costly. And the forwards appears in physical market and cash market as well. Again, physical market means those who needs the real commodity. So this is a good example. Jet fuel airline, they need fuel. So if they buy a forward transaction, what they need oil. But in the if you buy the cash market forward contracts, you don't get oil, but you get the difference between prices. That can happen in the forward market as well. So foreign exchange transactions and things are in the cash market, interest rates and things like that. Advantages of forwards: you have the flexibility because you can customize, you can decide the date, size, and most of the terms which are fixed in the futures market. And in the futures market, there are few underlines, but lot of underlines, but still limited. But in forwards, whatever the underline, if there's a counterparty, you can enter into a transaction. So basically, most commercial banks, they provide this. We can use futures or forwards again to speculate, hedge, and to get the advantage of arbitrage. I have a doubt whether we'll be able to discuss this, how to explore arbitrage opportunities using derivatives given the time frame. But let's see whether we will be able to discuss this. But at least in risk management, we'll discuss how to hedge an existing position using derivatives. So in risk management, we will use these derivative products again, especially futures and options, how to hedge your existing position. I'm not going to discuss that here, but futures and forwards, we can use it for speculation purposes, hedging, or arbitrage purposes. So that's all about futures for the time being. Again, you have another handout for futures 2. But today I'm not going to discuss that. We'll move into options. We'll discuss basics of options and finish other derivative products as well, interest rate swaps and FRAs. Then if time permits, we'll move into options 2 and futures 2. So is there any question?
So this forward contract, you mean that may not mark to mark daily in the sense, why is the reason? Is it difficult
Say,
to mark?
yes, you have to get the market price and calculate the difference and maybe adjusted for the time value. And it is only for, so different contracts have different terms. Then you have to work out individually each and every contracts. It's a bit difficult because there's no price, market price in, say, if you enter into a forward contract to buy for $1.2 million in on say 16th September, there won't be any other transaction in the market, same volume, same date. So you cannot find a proper pricing for that to do the mark to market. It's
forward premiums are available there,
but not for the same maturity. No? Yes. Say that's why I said 16th. When I said 16th September, today's 2nd August. How many days? After 10 days, would there be any premium for that? It would be difficult and it's costly to do that. Therefore, generally, you don't do mark to market daily. But now the market is moving away from that. Even the over the counter transactions, now they are trying to bring it to a sort of another arrangement we call central clearing counterparty. So all the transaction over the counter transactions with some standardization, they are trying to bring it to a one settlement party and do that novation. That means break it into two parts, two agreements between the parties and the CCP, central counterparty. That is happening in the global market now, but still there are limitations.
Okay. And one last question, that on slide number 22. 22.
Yes.
They are now we multiply into no 23. When it comes to calculate this loss in ticks, why we use 2? Why we use 2 is the reason behind that is we use the double 8784 and 8715. That is the reason.
That is this is in the 6th decimal place. Say for 84 to 85, the movements are 2 ticks. Say forget about that 8715. Assume 8784 to 8785 market moved. How many ticks?
Okay.
2 ticks, because the ticks is in at the one tick is at the 7th decimal place, not the 6th decimal place.
Yeah.
First, the price has to move to 87845, then 8785. So there are two. The market has moved 2 ticks. Clear? 0.8784 to 0.8785. Market has to move by 2 ticks, not by 1 tick. Since all these are in the 6th decimal place, you have to multiply it by 2.
Okay.
So back to this. See, this 5 is in the 7th decimal place,
7.
not in the second 6th decimal place. So you need
Okay.
2 ticks to move the 1 point in the 6th decimal place. Clear? That's why we multiplied this by 2.
Tick is equal to 0.5. 0.5.
Sorry?
One tick is equal to
6.60 and 5. It's in the 7th decimal place.
Okay. Yes.
See, 1, 2, 3, 4, 5, 6, 7. So this is in the 7th decimal place. So move to change the 6th decimal place by 1. You need 2 movements of this tick size. Clear?
Yes. Yes. Yes.
Any other question? Okay, if not, we'll have a break here. After the break, we'll start options. We'll have a 15 minutes break. Even today at the beginning, we discussed 2 types of broad categories of derivatives. One is with overt commitments, other one is with contingent claims. Options falls into the second group, that with contingent claims. So this is a bit tricky. Pay your attention. An option that gives a right. So option can be bought or sold, but option gives a right to the buyer. The option gives a right to the buyer. Remember that, not to the seller. So usually when we say buy, you buy something. When you say sell, you sell something. But here, in option, when you say you buy an option, you get a right. You get a right to do what? We'll discuss later. But when you buy an option, you get a right. But if you are a seller of the option, you don't have any right, but you have the obligation. That's the main difference. But the other thing is, to the buyer, there's no obligation. For option, buyer will get a right, but no obligation. But to the seller, there's an obligation. So what is the right that the buyer will get is to sell or buy a particular asset. Buyer of the option will get a right to buy the underlying asset or to sell the underlying asset based on whether you are get the right to buy the underlying asset or right to sell the underlying asset. We classify options again into 2 different classes. We'll discuss that later, but for the time being, remember, buying an option will give the buyer a right to buy the asset or sell the asset. The price is agreed, and the other thing is timing. It is again on or before a specified date. The buyer can buy the asset or buyer can sell the asset on or before a specified date. Again, we break that options based on this timing. So in some contracts, it is during a period before expiry date, but in some contracts only on the expiry date. So again, based on the timing, we divide options into 2 categories. Not only that, we divide based on the right that the buyer gets. Is it clear? What is getting by the buyer? So buyer has the right to do what? Either to sell or either to buy an underlying asset, but that depends on the type of the option contract the buyer bought. It doesn't mean that through a single contract the buyer get the right to buy and try to sell. No, either to buy or to sell. So basically buyer gets the right but no obligation. But on the other hand, seller of the option, he assumes an obligation. If the claim is made by the buyer, the seller has to meet that obligation. And the seller of the option does not have any flexibility or the right, any right other than only thing is the seller has to meet the obligation based on the contract. So again, underlying assets for options, it can be a bond, currency, commodity, short interest rate, stock, particular stock or index, or it can be option on a futures contract as well, what we discussed. That means you enter into a transaction to buy a futures contract on a future date at a particular price if you wish. By entering or by buying an option, it does not mean that you have to do. But to seller, if that claim is made by the buyer, the seller has to meet that obligation. So because whatever the underlying asset, bond, currency, commodity, or whatever, we call it underlying asset. And the strike price or the exercise price, that is the specified price in the contract. Say you agree to buy a particular stock at 99 rupees, the strike price is 99. So we call it strike price or exercise price. The price is agreed when you enter into the option contract. And again, like in any other product, buyer or the holder or the owner of the option is the long party. We call you are long an option if you have bought the option, not the underlying. Remember, buying the option and buying the underlying is two different things. But in a futures, when you buy the futures contract, you agree to buy the underlying. But in options, you buy the option, but it does not tell that you have the obligation to buy the underlying. It can be to buy the underlying or it can be to sell the underlying. Two different things. So here, buyer means buyer of the option or the holder of the option or the owner of the option. All three refer to the same party, the long party of the option. He has the right. Options with seller, or we call the same party as the writer, option writer. That is the short party, short of the option, not the underlying. Then, as I mentioned, the buyer has the right, the seller has the obligation. So it won't come free of charge. There's a cost. To buy the right, you have to pay something. We call it a premium. If you can remember, last week I explained with insurance. You buy the insurance by paying a premium, but later whether you make the claim or not, it's up to you. If you make the claim, the insurance company, legitimate claim, the insurance company has to pay the claim. Options also like insurance. The buyer pays the premium, then the seller is like the insurance company. If the claim is made, the seller has to meet that obligation. So the premium, that is the cost paid by the buyer to the seller, and it's non-refundable. Once you enter into the agreement, you pay the premium, it won't return. It is non-returnable or non-refundable. That is the income to the seller. We will learn it. That is the maximum income that the seller will get. So premium is paid by the buyer to the seller to get that right. Then we'll come to the two types of options. One is we call call option. The other one is put option. So, I mentioned earlier, when you buy an option, you get the right. The call option specified what is the right that you get. Call option specified what is the right that you get. If you buy a call option, you get the right to buy an asset, the underlying, which is specified in the contract. So remember, call option give a right to buy an asset or buy the underlying as the buyer. The buyer will get the right to buy the underlying in call options, and for a specified price, that is strike or the exercise price, on or before a specified date. So you can buy the asset during the life period of the asset, of the option contract, lifespan of the option contract that you agreed. But again, that depends on the type of the contract. Some contracts will give you the right to buy only on the specified date or during the full period, anytime during the period. That is again depends on the type of the contract that you entered. But call option, remember, you get a right to buy an asset. Then the put option, the other one is put option, that gives the buyer of the option a right to sell an asset. Put option gives the buyer right to sell an asset. Remember, call option to buy the asset, put option to sell the asset. But whether it's a call or put, you buy. Once you buy only, you get the right. It's not that you are selling put option to get the right to sell. No, you buy the put option to get the right to sell. You buy the call option to get the right to buy. Again, even in the put option, the price is defined and the maturity and the expiry date and other terms are specified, whether you can exercise anytime or only on the maturity date. Is it clear? What is a call option? What is a put option? I repeat it. Call option gives the right to buy an asset to the buyer of the option. Put option gives the right to the buyer to sell an asset at a pre-agreed price. So then, okay, we'll go back to this and consider example. Contract 1. You bought a December 2020 call option on shares of ABC company. Price of a December 2020 call option is 35.75. The strike price of the call option is $66. What does it mean? What is the price of the option? That is the premium. Price of the option is the premium. So you have to buy the option, you have to pay $35.75 to buy the option. Then the strike price of the call option is $66. That means you can buy the share of ABC company in December by paying $66 per share. And again it says December 2020 call option. That means expiry of that option falls in December. So basically, when we see like this December 2020 call option, something like this is basically, again, options can be traded now. Most of the options are options traded in through exchanges. So this can be considered as a exchange traded option contract. So, but I'm not going to specify that too much. If it is exchange traded, again there will be specification of the contract. What is the size of a contract? So when we say call option on a share of ABC company, per contract, how many shares? That has to be specified. So then this premium, is it for the one contract or per one share? I think in this example, since this is a exchange traded one, this premium is for the contract, not per share, but the strike price is per share. So however, when you buy this call option, you have a right to buy the shares of ABC company, and the number of shares is specified in the contract. You have the right to buy that number of shares of ABC company, paying $66 per share, but you can do that in December 2022, and based on the date specified in that contract. If you go to the second contract, that's a put option, that you buy a put option, so then you receive a right to sell the shares of ABC company, XYZ company. You get the right to sell shares of XYZ company at the price of $378 per share. So there's a small mistake here. This should be strike price of the put option, not the call option. That should be strike price of the put option. So then 70 is the premium that you pay to get that right. Clear? You pay a premium to the seller of the option to buy a right. If you buy a call option, you get the right to buy the underlying. If you buy the put option, you get the right to sell the underlying. Clear? That should be crystal clear. Otherwise, you will get confused in the future. Yes.
That means when it comes to call option, it's right to buy.
Sorry?
In the right way, the call option means it is right to buy.
Right to buy, yes. Put option means
then,
right to sell. Yes, to the buyer. Okay. Remember, then, from the buyer's perspective, from point of view. Put option or the call option, from the buyer's point of view of the option, you get the right. If it is a call option, you get the right to buy the underlying. If it is a put option, you get the right to sell the underlying.
Okay. When it comes to exercise the call right to buy call option.
Yes. Then what do you do? Price, yes. You agree to buy at that. So if we go back to this one, your agreed price is 66.
66.
Say assume on the expiry date. On the expiry date, as a buyer, you have the right to buy shares by paying $66 per share.
That means in a call option where buyer will exercise the option, in a scenario, real market value of the particular share is more than the strike price. Is it?
Exactly. Yes. So we'll come to that. When to exercise. How do you exercise your Right, we'll come to that. First, understand what do you get as a buyer of a call option?
Right.
What is the right that you get? What is the right that you get as a buyer of the put option?
Okay.
If it is clear, yes, we can move forward.
Yes.
And two more classifications, American option and European option. In the previous definition, we mentioned that you can exercise, or the buyer has the right to buy or right to sell on or before a specified date. So in this example, it's December 2020. Say 15th December 2020, that's the expiry date. So if it is an American option, from today and until 15th December 2020, at any time you can exercise your right as the buyer. In an American option, any day, anytime you can exercise your right. Is it clear? In an American option, anytime you can exercise your right until the maturity date, on including the expiry date. But on the other hand, European option, it is only on the expiry date, not before that. So if the expiry date is 15th December 2020, you can exercise your right only on 15th December. But in an American option, even before that, you can exercise your right. Clear? The difference between American option and European option? That classification is based on the timing. When the buyer can exercise his or her right, buyer right to buy or sell, whatever it is. Call and put option are based on the right that the buyer gets. Call option gives the right to buy, put option gives the right to sell. American option, you can exercise your right as the buyer of the option at any time until expiry. But European option, you can exercise your right only on the expiry. Yes. So that has to be clear. Then, yes. What do you do? Say, go back to the previous example, contract 1. Price of a December call option 35.75. This is the premium. Strike price is 66. That you agreed to buy at 66. Okay. Assume this for simplicity. From here and onwards, I assume European options because it's easy. On the expiry date, you check the market price. It is 65. Will you exercise your right? The market price of the shares of ABC company is $65. Will you exercise your right?
No.
No. Why? You have the right to buy at 66. Market price is lower than the your agreed price. So it's cheaper to buy from the market than exercising your right. So you let it expire. You don't take any action. You don't make your claim. That's why it says contingent claim. If the price is at least equal to the strike price or above, only you will exercise your right to buy. If the market price of the underlying asset is at least equal to strike price or above, then only you will exercise your right. Clear?
Yes. But
yes.
If the strike price equal to market price, there is a cost of premium as well. Then
whatever the price, the cost of premium is there. Yes. When do you pay the premium? That's a good thing. When do you pay the premium? Whenever you enter into the transaction, that means enter into the option transaction. That means you are buying the option transaction, you have to pay the premium. So to buy this December 2020 call option, today you have to pay the premium. So
at the time of you get into an agreement, on that day you
yes,
have to pay.
at the time that you enter into the option contract, you pay the premium. So that is a sort of sunk cost. You incur that cost already with independent of the outcome of the transaction, whether you make money or lose money. Clear? So whether the spot price is less than the strike price or more than the strike price, it doesn't matter. You have paid the premium. But on the maturity date, you forget about premium. On the expiry date, you forget about premium. You compare the market price, market spot price, and the strike price that you agreed. If the strike price is lower than the market price, you exercise your right to buy. If the market price is lower than the strike price, then you exercise, market price is higher than the strike price, then you exercise your right to buy. Remember, this is a call option. You exercise your right to buy if the market price is higher than the strike price. Otherwise, you won't exercise that. So in this example, spot price of the share at the expiry is 80.75. So it is above 66. So therefore, you exercise your right. Clear? If it is below this 66, 65.99, still you won't exercise your right. Even a 1 cent matters. You won't exercise your right. You will buy it from the market. Clear? The contingent event is whether market price is above the strike price. If the market price is above the strike price, then the buyer will exercise the right. And remember, even in that case, seller won't come and say, hey, now your option is expiring, please exercise. He won't tell it. The buyer has to exercise it, send in the necessary instructions to the option seller. Option seller won't come and say, please exercise this. No, it won't happen. He is happy to let it expire. If you forget to exercise, option expires without exercising, but it was making money, you cannot find any fault with the seller of the option. He has no obligation to honor unless you make the claim. So you have to make the claim, then only he will honor it. Clear? But the thing is, you won't make the claim unless you see some profit or gain or advantage of exercising your right. So this is the diagram, the payoff diagram. I'll explain it, how to get it. Remember, in option, we have two diagrams, payoff diagram and the profit diagram. This one is just the payoff. That means what do you get on the expiry date. Again, y-axis, it's not the profit, it is payoff. X-axis, the spot price of the underlying asset. Say in this example, 66. We denote that strike price as X. 66 is the strike price. Okay. If the spot price is 65, what do? You are the buyer. You are the buyer of this option, call option. You have the right to buy the shares at 66. But the market share price is 65. Will you exercise your option?
No.
No. Will you get any cash flow?
No.
No. So the payoff is 0. 64.
No.
You won't exercise. No cash flows. So even at 0, no. So below the exercise price, there's no payoff, cash flows. So this is the exercise price, strike price. Below that, as a call option, and remember, this is to the buyer. We draw this diagram from the buyer's point of view. There's no payment or receipt of any cash until you reach this price. At 66, yes, it's indifferent whether you exercise your right or you buy it from the market. So again, it's 0. But if it is 67, what would happen?
Exercise.
You can buy the shares at 66. Market price is 67. You can buy the shares at 66. So there's a gain of $1 or the difference of $1. Generally, what would happen when the options are settled, when you exercise your right, he won't, or the seller won't deliver you the shares. He will pay that difference. Even seller delivers you shares, you can sell it at 67, realize $1. So that is we call payoff. So at 67, it is 1. At 68, it is 2. Likewise, the payoff will increase. So from strike price and higher spot prices, it would be a straight line like this. That is the payoff diagram for the call option. That's just the payoff. We didn't consider the premium that we paid at the beginning. Is it clear?
Yes.
Below the strike price, the buyer of the call option will not exercise his or her right, so therefore he won't get anything. But above the strike price, when the market price is above the strike price, the buyer of the option will exercise his right to buy the underlying, and he will get this payoff. Is it clear?
Yes.
So So this diagram explains that one. For a long call option, what is the payoff? Sorry, this one is the profit, not the payoff gain. This is the payoff diagram for the call option. So in the diagram shown in the presentation is the profit. So you can see in this axis, it is the profit. What do? We have incurred a cost. What is that cost? It is the premium. So before the expiry, we don't get any gain, but there's a cost of that premium. So it is a loss. But again, from this point and onwards, it will go up like this. Whatever this difference is the premium. When the profit, this is the profit. So that is the profit drive. Black line is the payoff. Red line is the profit. Profit is nothing but the payoff minus the premium that we paid. Until the strike price, when the spot price below the strike price, we make a loss equal to the premium. Beyond that, when the spot price is above the strike price, we make a profit. The price at which the profit equals or profit is zero, that point we call break-even point. That comes as strike plus the premium. Premium for one unit of the underlying asset, not for the contract. X is the strike price, P is the premium for 1 unit of the underlying asset. So this is called the profit diagram. And this point is called break-even point, where you get zero profit. And remember, since now you learn this break-even point, now you will get confused when to exercise your right. Since profit is zero, exercising before the break-even point is not worth. It's not the case. Remember, if you don't exercise in between that, what would happen? Your loss would be at this level. But if you exercise, at least your loss will reduce. If you exercise in between 66 and the break-even price, whatever it is, if you don't exercise, your loss will remain same at the premium level. But if you exercise, your loss will be reduced by this amount. So therefore, to make the decision whether to exercise or not, it's basically depends on the strike and the spot price. If the spot price is higher than X, the strike price, you exercise your right for a call option. Is it clear? Any question?
In Sri Lanka, can we see these type of options?
Yes.
Options
Yes. In Sri Lanka, you can do this.
Is it something called that dual currency deposit?
Dual currency deposit is a deposit plus an option.
Deposit plus an.
So it's a derivative. Again, as I mentioned at the beginning, plain product deposit plus a derivative. That derivative is the option.
But that dual currency deposit will give higher interest rate than the normal deposit rate.
Yes, but it's depending on the exchange rate. No?
Okay.
But you get back depends on the exchange rate on the expiry date.
Okay.
So whatever your FX gain or loss is included into that interest. That's how it is priced.
They are okay. They are also buyer has given something similar right to exercise.
That can be a buyer or seller, I think, if I remember correctly. Dual currency option. Though you place the deposit, it can be the option can be from your side as a seller or buyer. That depends on how do you price it. The long call option, the maximum loss is the premium. Go back to this, you can see this is the maximum loss that occurs if the spot price is below the strike price. That's the maximum loss. As a call option buyer, the maximum loss is the premium, but in between the strike price and the break-even price, your loss will be less than the premium. It will reduce and it comes to zero when it comes to the break-even price. So the maximum loss is the premium and it is limited. What is your maximum gain? Again, it can be anything. So it is unlimited. So that's why this is not like a futures. In futures or forwards, this line goes like this. So it's a symmetric. If price goes up, you make profit. If price goes down, proportionately you make a loss. But here, if price goes down, you won't incur a loss proportionate to that price decrease. Whatever the price level, the loss is fixed. So this has a asymmetric payoff options. But in the forwards or futures, it's a symmetrical payoff. But only thing is loss is limited, profit is unlimited. Here also loss is limited to a particular figure irrespective of the spot price or most of the time, and the profit is unlimited. So the break-even price, you get it when the strike price plus premium. this difference is premium. So this is the break-even price. X plus premium, you get this. But remember, this premium is for a particular one unit of the particular underlying, not for the whole contract. Contract may be for 1,000 units or 100 units or 250 units. Then the premium you paid is for the whole contract. Here this premium means for particular unit, sorry, for a single unit, what is the premium that you paid. Then the short call option payoff. What is the payoff diagram? If you are a seller of the call option. If you are a seller, what would happen? When you make a loss as a buyer, that would be the gain for the seller. So there will be a line up here. But from this point and onwards, that profit will go down and comes to zero at that level. Beyond that it's a loss. So this is the payoff diagram for the seller of the option. Payoff profit diagram indeed. If the strike price or the spot price is less than strike price, the buyer won't exercise his right. Then what the seller has to do nothing, just collect the premium. So that's the maximum profit. Nothing else that seller will get, only the premium. So until this point, he gets that premium. After that, what would happen? If the price of the shares or the underlying asset is higher than the strike price, still he has to sell that underlying to the buyer at this strike price. Then he is making a small loss. So the income of the total option transaction will go down, profit will go down equal to that loss. So therefore, the premium minus that loss is the profit. That will happen until it reaches the break-even point. Beyond that, it's a loss, completely a loss to the seller of the call option. So maximum loss is unlimited and the maximum profit is limited to the premium. The same break-even price, strike price plus premium. So again, remember, selling call option is riskier than buying call option. Why? Selling call option, by selling a call option, you exposed to the market risk and the risk is unlimited. The loss is unlimited. There's no end to the loss that you may incur. But the profit is limited, maximum to the premium that you collected. Clear? That's the basic of call option. Is it clear? Shall we move into the put options? So put option, if you remember now, as a buyer of a put option, what is the right that you get? As a buyer of a put option, you get the right to sell shares. You get the right to sell shares at a price, strike price 378. Again, just please change this to put option. It's not called put option. So as a put option buyer, you get the right to sell the underlying asset. So when do you exercise your right? If you go back, $378 or whatever that price, that's the strike price. That is X. That's the strike price. You are a buyer of a put option. That means you have the right to sell that underlying asset when the price is 378 of that particular asset. Okay, what do you do when the price is 375? Will you exercise your right or no? Yes, you will exercise your right. Why? You can sell it at 378, higher price than the market price. When it is 385, what do you do? When the market price of that asset is 385, whereas you have a right to sell it at 378, but no obligation. That's the important thing in option. You don't have any obligation to do that. So you can forget about your option contract, go to the market, sell it at 385. So if you do that, what do you get here from the option? You won't get anything through the option. So it will remain as this 0. But when the price is 375, you exercise your right. That means you sell something worth 375, but at the price of 378, you get 3 rupees or $3, whatever the you get. When it is 370, you get more. When it's 0, you get 378. So what you have to do, connect those lines. Then this is your payoff diagram as a buyer of the put option. You gain when the price goes or the falls below the strike price. If price goes high and high, you won't get anything. Clear? Then what is the profit? Again, whatever you get from the option minus the premium that you paid. So it will be something like this. This is profit. This is payoff. Again, the maximum loss is equal to the premium, but in this instance, it occurs when the price is higher than the strike price. You make a profit when the price is lower than the strike price. Again, there's a break even here. What is the break even price? That is strike minus premium. If the price falls below or equal to this amount, you won't make any profit. So this is the payoff diagram for a buyer of a put option. That's the payoff diagram for the buyer of the put option. So what would be the payoff diagram for the seller of the put option? It is the mirror image of the same diagram if you put the mirror on the x-axis. Same thing in the previous one as well. So the put option payoff for the profit diagram for the seller when the spot price is above the strike price, the seller will just collect the premium. Then in this it will go down. Maximum loss is the difference between 0 and 378. So this is minus 378. Sorry, 378 minus premium. So this is the profit for the seller. This diagram shows you the profit for the seller. Again, there's an example. An investor buys 3 FTSE call options with a strike of 5,200 for a premium of 12. At expiry, the cash index stands at 5210. So he has bought a put option. Sorry, remember here, this is call options again with the strike at this, and at the maturity index value is 5,210. So you can see underlying index value is higher than the strike price. What is the strike price? 5,200. Now it is at 5,210. So you will exercise your right. What is the gain on exercise? The difference between the index point, 10 index points. Remember, in this case, you get the gain in terms of index points. And the premium paid is 12 index points. Premium of 12. So it's premium of 12 index points. So therefore, overall position is a loss of 2 index points per contract, because your gain is only 10 index points. As the premium you have paid 12 index points, the gain is therefore overall loss of 2 index points. You know what is the value of index point? It's 10 pounds. So loss of 20 pounds per contract. So for the all three contracts, you lose 60 pounds. Another example, an investor buys 7 puts a put options with a strike of 5,300 for a premium of 15. At expiry, the cash index stands at 5,280. What is the gain or loss to the investor? Okay, this is that investor bought a put option. The strike is 5,300. On the expiry, the index is at 5,280. Is it a gain or a loss? Or will, if you are the buyer of this put option, will you exercise your right or not? Now the index value is lower than the strike value, strike price that you agree. So therefore, you will exercise your right. What would be the gain? The difference between these two. You will get a gain of 20 index points, but you paid a premium of 15. So therefore, the net is only 5 index points. Value of a 1 index point is 10. So per contract, you get 50 pounds. And for 7 contracts, you get 350 pounds. So index value is less than strike price. So it's worth to exercise your right. Gain is the difference. Strike price minus the spot price. That is 20 index points. Then you have paid the premium of 15 index points. The net gain is 5 index points per contract. Value of an index is 10. 5 index points for 7 contracts and 10 pounds per index point. So 350 is your gain in this instance. So options, risks and rewards. If you are long in put option, we discussed the maximum loss is premium. Whether it's put or a call, if you are long, maximum loss is the premium. Remember that. In option, if you are a buyer of option, whether it's a put or a call, the maximum loss is the premium. But for a call option, maximum profit is unlimited. But for the put option, maximum profit is strike price minus the premium. This happens because you get the maximum profit. You get the maximum profit when the spot price is equal to 0. The difference between 0 and the strike price, the gain that you get on the option, but you made the premium. So this is the maximum gain. Premium, sorry, strike minus premium. This is the same level. So that's the maximum profit that you get on a long put option. Strike price minus the premium. Break-even price is also strike price minus premium. So the short put option payoff, it would be the mirror image of the buyer's payoff, but mirror image over the x-axis. For the buyer, it was like this. Then the short put option, you can see maximum profit. Again, for an option seller, the maximum profit is the premium. For an option seller, whether it's a call option or a put option, premium is the maximum gain, but maximum loss is unlimited in the case of call option. But when it comes to put option, maximum loss is the difference between the break even and zero. So the break even is the strike minus premium. Strike minus premium is the break even price. The maximum loss also the same. So in summary, the risk and rewards, when we summarize, when you have a long call option, risk is limited to the premium. Risk is limited to the premium in a long call option, but the reward is unlimited. For a short call, risk is unlimited. The reward of a buyer becomes the risk of the seller. Risk of the buyer becomes the reward of the reward to the seller. So limited to reward for the call option. Seller is limited to the premium. In the put option, buyer risk is limited to the premium. The reward is the difference between strike price less premium. Again, opposite is true for the seller of the put option. The risk is strike price minus premium, and the reward is limited to the premium. And options, again, you face the counterparty risk. Why? You enter into a transaction today and you are going to exercise your right if it is worth on a future date. By that time, the counterparty may not exist or counterparty may not honor your transaction. So as a buyer, you have the counterparty risk. As a buyer, you have the counterparty risk. But for the option seller, there's no such risk. Once you receive the premium as the seller, that's it. Whether the counterparty will remain until the maturity of the contract, it doesn't matter. If you make the claim, yes, as the seller, you have to honor that. Otherwise, you don't mind about the existence of the counterparty once you collected the premium. So as the option seller, there's no counterparty risk, but as the option buyer, you face the full risk of the counterparty, especially if it is at the money or in the money. We'll discuss what is at the money and what is in the money. So again, this is a summary of what we discussed so far, how to calculate loss or profit for a long call party. That means buyer of the call option. If the expiry price is less than the strike, it's a loss equal to the premium. If the expiry price is greater than the strike price, it is a gain or loss. It can be a loss as well if the difference between expiry price and strike price is not big enough to cover the premium. It will become a loss. Otherwise, it will be a profit. It's the difference between expiry price and the strike price minus the premium. So again, these two reverse for the short call part. That means for the call seller. For a long put, if the expiry price is less than strike, then it's a gain, or again it can be a loss. But the difference between strike price minus expiry price minus premium is the gain or loss. If the expiry price is higher than the strike price, then it's a loss of the premium. That loss becomes the profit for the option seller. Then the gain or loss of the buyer of the put option becomes the gain or loss of gain of the buyer becomes the loss of the seller of the put option. Loss to the buyer becomes the gain to the seller of the put option. You can see strike minus expiry here for the short, expiry minus strike, plus premium minus premium. So it reverses. The same thing you can. So just switch off or change these. This is the basic of options, put option and call option, and American and European. What is an option? Again, to summarize, option gives the right to buy or sell to the buyer of the option. Buyer of the option gets a right to buy or sell. Whether that right is buy or sell depends on the type of the contract. If it is a call option, the buyer of the option gets the right to buy the underlying. If it is a put option, buyer of the option gets the right to sell the underlying. When do you have that right? That depends on whether it's an American option or a European option. In an American options are much flexible. So therefore, during the lifetime of the contract, you can exercise your right as the buyer at any time. But the European option, the buyer of the option has the right to exercise his rights only on the expiry date, not before that. So that's the basic. Then what is the payoff diagrams and profit diagrams? How to calculate payoff and profit? What is the break even point? What are the risks for the buyer of the call option, buyer of the put option? What are the risks to the buyer of the seller of the call option and seller of the put option? Those are the things we discussed so far. So we'll move forward. These are the basic types of options that we discussed: call option and put option, and American or European. Call and put, that depends on the right the buyer of the option gets, and American and European depends on the timing of the exercise. But there are few more option types, much sophisticated ones than the ones we discussed. One is look back option. You just know that there are these type of options and basic rules. In the look back option, again, that can be a call or a put. So whether you have the right to buy or sell, that depends on the whether it's a call option or a put option, look back call option or a look back put option. Depending on that, buyer will get the right to buy or sell. So in that, owner has the right to buy at the lowest price over the some preceding period. Say 3-month period, you enter into a look back call option today, and for 3-month period, then at the end of 3 months period, you look back what are the prices at the were during that period. you take the lowest price as the strike price. Then the difference between lowest price and the price on the expiry date, you will get it as the payoff. That is for the call option. If it is for a put option, you take the highest price as the strike price. The difference between the highest price and the price on the expiry date, you will get it as the payoff. Is it clear? That's why it says look back. You wait until maturity. On the maturity date, you check the historical price and select the lowest or the highest price as the strike price, depending on whether it's a call option or a put option. So in the Asian option, again, it's in between American and European. As usual, we mix everything American styles and European styles. So we come up with nothing. So Asian option is also like that. It's a mix. So in this, the payoff depends on the average price of the underlying asset over the period. We compare the underlying asset and the other one is the barrier option. So for that, even though you enter into the option agreement, it is not activated at the initial. Initially, it's not activated. During the lifetime, price has to reach some level to activate the option. We call it knocked in. Or it can be other way around. Initially, the option is valid, but if the price reaches some level, then beyond that, the option is no longer valid. You cannot exercise. So we call that knocked out. So barrier option, it can be a knocked in one or a knocked out. So again, that can depend on whether it's a put option or a call option as well. So however, the key is the price has to reach to a predetermined price. If that price is reached, if it is a knocked in option, then you can exercise your right. If it is a knocked out option, then after that you cannot exercise your right. The other option is type of the option is binary option or the digital option. As the name indicates, binary, the payoff is fixed. If the criteria is met, you get a fixed amount. If not, you don't get anything. So the payoff is a fixed amount or nothing, 0 or 1. So that is binary. In binary, we have either 0 or 1. Likewise here, either you get nothing or you get a fixed amount. That's the key in a binary option. Bermuda option is in it's again a very somewhere in between European and American. In European option, you can exercise only on the maturity date. In American option, you can exercise your right anywhere in between or before maturity or on the maturity as well. In the Bermudian, what do? They specify some time or the dates during the lifespan of the option. If it is a 3-month lifespan, maybe every month end or every Wednesday. Likewise, they specify some exercise dates during the life of the option. So those type of options are called Bermudian options. Again, it can be either put or a call. Then the last one, options on futures. As I mentioned at the beginning, an option on the futures gives the holder the right. Again, option gives you the right to do what? Either to buy or sell. Here, to buy what? To buy a specific futures contract, or to sell a specific futures contract. So that depends on the price of the futures contract, not the price of the underlying. So to become the buyer or seller of a specified futures contract, whether you get the right to buy or sell, that depends on whether it's a call option or a put option. So this is an example of a futures option on futures. An investor purchased a call option on a June Euribor future. What is Euribor? That is the Euro interbank offer rate. That's again interest rate futures. You purchase a call option on that. That means you have a right to buy the Euribor future. So in future, the buyer would become a buyer of the futures contract upon exercise of the option. If you exercise that, the option seller would be assigned a short futures contract, because once buyer exercise his right, the seller should sell the futures contract. So that is all about basic of options. If you have any questions, you can ask. Next week, we'll discuss about option 2, because in that we discuss about in the money, out of the money. I think that is important. So we can discuss that next week. But to understand that, you need this basic. What is an option? What is a call option? Put option? What is the right the buyer will get if he buys a call option? What is the right the buyer will get if he buys a put option? What is the payoff? When to exercise your right as a buyer of an option? These things we need. So if you have any questions, please free to ask. If you don't have any questions, we'll stop here. We don't have enough time to start the other topic. So it seems you don't have any questions. So we'll stop here and we'll meet next Sunday morning. See you.